Learning objective 3 is solely on the topic of notes receivable, and it's important to sort of understand how notes receivable happen, right? So remember, the word note means loan, um, and you would think that the only businesses that actually have loans going on are banks, which is true. That's how they make most of their money. However, businesses recognize when they're doing business with other business. All of these are based on business to business transactions. Okay. That you can sell to a business on account and give them 30 days to pay. That's an accounts receivable. But what if they need longer? What if they need 60 days, 90 days, 120 days, or longer? Can you do that? Yes. That's where the note receivable really is born. Most notes receivable are created to settle an accounts receivable. So, in other words, accounts receivables are due within 30 days, but the business who owes it needs more than 30 days. So, the business who granted that, sold it on account, said, okay, fine, let's turn it into a loan. And that's basically all a notes receivable is, and that's how most of them are created. Okay. Notes receivable are it's a legal instrument. It has a date. It has the amount of the loan. It has an interest rate. It has a due date. In this case here, 2 months. It's signed by the folks who need the loan and shown that they're paying the company who made the loan, right? That they owe this $1,000. So, in essence, the payee is the one who's granting the note. They're waiting to receive the loan. The maker is the one who actually needed the loan. So this same note is a payable to the maker. It's a receivable to the payee. So very important to sort of understand. I also need you to point out too that the interest rate that's listed here is an annual rate. Remember, this is for all 12 months. We're only going to need 2 months of interest on this loan. And how notes receivable work is they're due in full on the due date. Okay. So if you had a date of May the 1st where this loan happened and it's due in 2 months, you simply count 2 months. So May, June, July. So July 1st is when this is going to be due. Okay. When it's listed in months, we're just changing the month. That's it. But notes can also be done in days, and we'll talk about that in a moment. So like I was mentioning, the actual due date of a note is called a maturity date. Okay. So on the maturity date, everything is getting paid. The full amount of the loan is getting paid, plus the interest is paid all at one time. Now, many notes are listed as in months. So 2 months, 3 months, 4 months, 5 months, etc. You can have a note that's longer than 12 months. It's just not common, to put it that way. But you can have them. That does happen. But most notes are short term, so therefore just a few months or so. Most notes are listed in months. However, you can have notes that are listed in days. And it's important to know that if a note is listed in days, it's going to be in multiples of 30. So in other words, they'll have a 60-day, 90-day, 120-day note. They're all going to be multiples of 30. Okay. It's just a simplified way of looking at each month as 30 days. And for the sake of calculation, again, these are not banks that are making loans. These are just business to business loans. Okay. So when we talk about days, they're going to be in multiples of 30. So the most important thing in this part of the chapter is learning how to compute the interest and understand how it's done. Interest is computed simply by looking at the amount of the loan. The face value of the note is the amount of the loan. Remember, the word note means loan. We multiply it by the interest rate. Remember, the interest rate is an annual interest rate, which means it's all 12 months. So we can't stop right here. We have to multiply it by the amount of time that we are allowing. So again, time is going to be expressed either in months. So if it's in months, it's going to be the number of months over 12. Okay. So for example, the one that you just saw was a 2-month loan. So it's the face value of the loan times the annual interest rate, which is all 12 months, times 2 months over 12, 2 divided by 12, because we're only getting interest for 2 of the months. Okay. And that's going to be your amount of interest. If it's in the number of days, like I said, they are going to be in multiples of 30. They're, 60, 90, 120, 150, 180. That means that the number of days, if we need to use it, it's going to be expressed as the number of days over 360. Okay. And that's simply going to be, again, if it's in months, we're going to use the number of months over 12. If the time is in days, we're going to use the number of days over 360 for this part of the equation. Okay. So here's some examples. Let's look at the first row. We have a $730 note at a 12% rate. Again, that's for the year, times 120 days. So here it's in days, so we're going to need to use this part in the formula. So 730, that's the amount of the loan, times 12%, that's the annual rate, times 120 days, because that's the number of days the loan is for, divided by 360 days, which is the amount of days we're using in a year when we compute interest this way. So the amount of interest is $29.20. So what's going to happen at the end of this 120-day period? They need to pay back the face value and the interest all at once. So they're going to be collecting $759.20. Both the loan and the interest are all paid on its maturity date, on its due date. For the second note here, we have a $1,000 loan at 9% for 6 months. Again, it's in months, so we're going to be using the formula here, the number of months over 12 when we look at the time. So $1,000, that's the loan, times 9%. Again, this is an annual rate for all 12 months. So we need to multiply it by the 6-month period over 12. And that's going to give us $45 of interest. So on the due date, 6 months from now, they're going to be paying $1,045 all at once. $1,000 loan back plus $45 of interest. And this last one is simple. The reason you don't have to do much here is this. Remember, the interest rate is already an annual rate. And so if it's already an annual rate and you only have it for 1 year, you can even skip this step. It's simply 2,000 times 6%. That's going to give you your interest for the year because the interest rate is expressed in years, in an annual. So that's why the multiplication here is 1/1, because this is an annual rate. So you don't need to do anything with it. However, if it's for 2 years, we'd have to multiply it by 2. Because again, this just shows the annual rate. So if it's more than 1 year, 2 years, 3 years, we're going to have to multiply by those years. And that's it. I mean, that's really kind of the hard part of this here. Let's look at the bookkeeping piece of the puzzle here when we do notes. Now, remember, most notes receivable are used to pay an accounts receivable. So again, the accounts receivable gives a business 30 days to pay. If they need longer than 30 days, they would probably want to change things to a note. So notes receivable are often used to settle an accounts receivable, meaning to pay an account receivable with a loan. Okay. So here we have Brent Company wrote a $1,000 2-month 8% note dated May the 1st, okay, to settle the open account. They owe Wilma Company. So what's going to happen on May 1st? Well, they just said here they're using a notes payable to pay off their accounts sorry, they're using a note to pay off their account. So we are going to debit the notes receivable to show that that's used to pay their accounts receivable. So the account receivable for Brent is now closed. And now we have a note receivable for Brent instead. Okay. And again, this is important because notes have interest, right? Accounts receivable don't. It's a longer period of time, but you're getting compensated for waiting. What we're not going to get into, but the book does mention, it's important to know, notes receivable are an asset. It's going to be on the balance sheet. And just like any other asset, just like accounts receivable, sometimes they don't get paid. Sometimes notes receivable don't get paid. And so you also have to go through a process that gives some room for an allowance for notes being not paid. And so you can't, just because you're owed $1,000 doesn't mean that's the real value of that loan on the books. And so we have to also do the same thing. But if you're going to go on to accounting, like intermediate accounting, you'll find out more detail on how that's done. But here they just sort of introduce the concept to remember it is an asset. Notes receivable are disposed, and this is not exactly what we would say. We normally use the word dispose as throwing something away, but disposing a notes receivable in accounting talk could mean one of three things. One is the note is held until it's actually due and it's paid. So therefore it's disposed. Done. We're done with it. So that's ideally what happens to notes receivable. Unfortunately, as number two would show you, sometimes notes are not received. And so when you are expecting payment of something and it's not made, then that's default. That's what a default is. You're expected to pay on this date and you didn't pay on this date. That's a default. Okay. So for a note anyway. So that's basically what we're looking at here is the loan was not being paid. That's default. And so that means that the payee, who's the one who's going to receive the note, will need to deal with a bad debt. Okay. The third thing is actually very interesting because remember, notes receivable, just like accounts receivable, is an asset that can be sold. So they can actually speed up collection of the cash by selling their notes to a third party. Okay. So that does happen. Again, it's an asset, and as long as it's an asset, it has some value and it can be sold to a third party. And so that sometimes happens as well. When a note is paid on time, on its maturity date, we call it an honored note. So the terms of the agreement have been honored, right? However, when a note is not paid in full when it's due, that's what we call a dishonored note. Okay, dishonored note. So let's see how it looks on the books for a company that received their note receivable on time. In other words, the note was honored. Here we have Wolder Lend Higley Corporation, $10,000 on June the 1st. It's a 5-month, 9% note. So again, if you made the loan on June the 1st, and it's a 5-month note, you can calculate the due date just by turning the pages of the calendar: July, August, September, October, November. So November 1st is going to be the due date on this, or the maturity date. So when this is actually all matured, what's going to be the entry on the books of Wolder, who's expecting to receive this? Well, again, on the maturity date, they're going to be getting the loan back plus the interest. Right? So we're going to have to calculate some interest here. So they're going to actually get $10,375 in cash on November the 1st. $10,000 of it is the note. So that's fine. The other $375 here is interest. $10,000 loan times 9%. Again, this is for all 12 months. So that's why we have to multiply it by the time, because we're only taking 5 months of the 12 for interest, 375. If you earn money on a loan, it's revenue. So notice how anytime there's interest that's earned on lending, it's revenue. And so you're going to get an interest revenue credit to show that you've earned money by lending money.
Is the 10,000 just a repossession of the money?
The 10,000 is the loan that's being paid. So you were waiting to receive the 10,000, you got to 10,000. That's why you're crediting the account, because you're taking it off the books. You're no longer waiting to receive it. You've received it.
Okay.
Let's take a look at what happens if Wolder Company closes its books at the end of September. So say September 30th ends their fiscal year. They made the loan on June the 1st in this fiscal year. They're not going to get paid until the next fiscal year, right? November the 1st, they're not getting paid because that's how notes work, right? So that means that as of September 30th, they have earned $300 of interest on this loan, but they won't receive it until November the 1st, and they're closing their books. So remember, we go back to chapter 4, we have to do an adjusting entry for this interest. They put the wrong date here, so that's why I'm fixing it. So on September the 30th, which is the day they're closing their fiscal year, they have to recognize this $300 has been earned. This is income. This is revenue. And remember, the whole point of chapter 4 is when we close our books, all the revenue has to be there. All the expenses have to be there, right? So we're going to have to recognize that revenue, although we're not going to get paid until later. So on the 30th of September, that $300 that we've earned needs to be recognized as revenue for this fiscal period. So, but we're not going to receive it until the next fiscal period. So we debit interest receivable to show we're going to receive it later. We're going to credit interest revenue. And this is important because this is revenue that has to be recognized in that fiscal period. Okay. So what happens then if this is Wolder's fiscal year? What happens when they receive payment on November the 1st? Well, nothing much is going to change. They're still going to be getting $10,375 because the calculation hasn't changed. That's how much cash is owed to them that day. $10,000 is for the note. So the notes receivable will be credited to show that that was received. But this is where it does change. $300 of the $375 is interest that they already recorded as revenue last year and set up a receivable for. So we're going to credit the receivable by $300 to show we received that interest. And then the $75 is interest that they earned this fiscal year. And so it's going to be revenue for this fiscal year, interest revenue. So it's just simply breaking it up. All right, so a little bit of review on that with the DoIt exercise. And learning objective 3 will be in the books here. Gambit accepts from Leonard a 3,400 90-day 6%. No, this is a day. This is in days. 6% note dated May the 10th. Now, when it's in days, we're going to need to do something a little bit different. Why did they take the note? Because they had to settle the open account. So in other words, they used the note receivable to pay their accounts receivable. That was earlier in the chapter. That's important to know. It says the note matures on August 8th. Well, yes, because you literally have to whip out the calendar and count the number of days. So if you made the loan on May the 10th, one day is May 11th. 2 days, May 12th, right? You have to count 90 days. And when you're done counting 90 full days, you're going to stop on August the 8th. That's when it's actually due. So August 8th is the maturity date. What does, what happens on the books of Gambit when Leonard pays this note? Well, again, they're paying back the loan plus the interest on the loan all on the same day. So we're going to have to do a little calculation of interest. $3,400 loan times 6%. Again, that's for the entire year. But this is a 90-day note divided by a 360-day year. When we do days, this is how we do it. $51 is interest that we're going to earn on this. So we're going to be collecting $3,451 in cash. 3,400 of that is the original note, so that's been paid. $51 of that is money interest we earned on that note, so that's revenue. And that's learning objective 3. Learning objective 4, there's 2 parts here that you need to know. One is looking at how receivables are presented on the balance sheet. This is a partial balance sheet for Deere & Company. I'm not sure if you know how big Deere & Company is, but you've probably seen their products, right? The nice green tractors on farms, and you've seen a Deere lawnmower, maybe a riding mower, others on that people might use on their personal property. But Deere's a large manufacturer of a number of different these types of goods. And clearly they have lots of receivables. How much? Well, 37 billion. These are, so in millions means you have to add 6 zeros to all these numbers. So that makes this number 37 billion. Okay, 37 billion. I don't know what you think, but 37 billion is a lot of dough. Get it? A lot of dough. Okay. Again, you see here they subtract out their allowance for their doubtful accounts. They call it the allowance for doubtful trade receivables. Allowance for doubtful accounts, they subtract that out. But they still, as you see here, 36 billion, as you see, is quite a few bucks. Okay, these are all like really bad Deere jokes. Okay, so eye rolling going on, perhaps. Managing receivables is big and very important business. Again, you have to decide, these are mostly for business to business transactions, right? So when one business does business with another business, they have to decide, are we going to extend any credit? Are we going to allow them to buy on account? Okay. Because that sets up the receivable right away if they do. So who do you extend credit to if you're a business doing business with other businesses? And then what's the payment period? For most industries, it's 30 days. There are some industries that the standard is more like 45 or 60 days. So it really depends on the industry, but the most common payment period is 30 days. You always have to be on top and monitor all of this stuff, what's due when. You have to make sure you're collecting your receivables on time. So we're going to be evaluating this with some financial analysis very soon, the liquidity of your receivables and if you're doing it well. And you might want to accelerate your cash receipts, which means you want to collect your money faster if you perhaps decide to offer terms, right? 210 net 30, pay early, get a discount. That helps to accelerate your cash receipts. Are you putting anything in place that helps people want to pay you faster? That's basically what that's talking about. So your book talks a little bit about that, but what I'm going to focus on, is the financial ratios. The most important one you have to know here is the accounts receivable turnover. So again, how many times are we collecting our receivables? Now think about it. If you have receivables that are due every 30 days, which is the standard in most industries, how many times a year on average should you be collecting them? Well, there's roughly 12 30-day periods because 30 days is roughly a month, 12 months in a year. You should be collecting your receivables at least 12 times per year. So we're looking at a turnover rate of how many times a year on average should you be collecting your receivables. 12 is the standard. 12 or more is good, right? So we're going to calculate our receivable turnover rate for these companies. That's the important thing. Once you know what the turnover rate is, you can just simply throw that number underneath 365, and it actually gives you the amount of days it takes you to collect your receivables. And that's also good information to know. So let's see how it works. First of all, introduction to the formulas. The accounts receivable turnover formula. Again, this is where everything starts, so it's very important that you learn this one here. We have our net credit sales divided by our average net accounts receivable. So an average receivable, you got your beginning accounts receivable, your endings accounts receivable. You're taking an average of those two numbers. Okay. Once you get that, you can put that number underneath 365, and it'll tell you how many days it's taking you to collect. So let's take a look at the accounts receivable turnover for Nike in 2014. Okay. So Nike in 2014 had over $27 billion in net credit sales. That's that top number here, net credit sales. We divided that by the average receivables. So we had accounts receivable beginning and ending accounts receivable. We averaged those two numbers. When we do, our accounts receivable turnover is 8.5. So 8.5 is well below that 12 times we were talking about on the last slide, right? 8.5 is slower than average. How slow? Well, put the 8.5 underneath 365, and it'll tell you that Nike in 2014 was waiting almost 43 days to collect an accounts receivable. Now, that's not good because we want to wait no more than 30 days. Here, they're waiting 43 days to get paid. Remember what a receivable is. You've already delivered the goods. You're just waiting to get paid for them. You know, how long do you want to wait? You don't want to wait too long. Nike's waiting 43 days when it should only be waiting 30 days or less. However, as you see from the 2013 numbers to 2014, they were waiting a longer period of time, right? Their turnover rate went from 8.1 to 8.5. That's good because it's getting higher. And their collection period went down, which is good because you're collecting money faster. Problem is, it's not fast enough. Okay. Looks like they're going to need some new sneakers at Nike.
Is that a thing that happens with bigger companies? The bigger it gets?
No, as you see, I mean, we'll get to that because the industry is listed here. No, I mean, these are just this is just something that's upsetting specifically to Nike. They have to do something about collecting their receivables better. So here in 2014, you have Skechers information is here. Their receivable turnover is 9.6 times. Now that's higher than Nike, but still well below 12. When you put 9.6 under 365, they're waiting 38 days. Okay. Again, your receivables are due in 30 days. If you want to get paid every 30 days and you're waiting now 38 days to get paid, there's a problem there. Right. So that's a little bit sketchy for Skechers. No. The industry average, now this is all the, and this is why I was mentioning to Greg, no, it doesn't happen to bigger, the industry includes all of these, so not just Skechers and Nike, but, Reebok, Adidas, all the, what we call athletic wear companies. They don't want to be known as just sneakers. They want to be full athletic wear. When you go to a gym, they want you to be head to toe dressed in Nike or Skechers or, Under Armour or whatever, all the ones that are out there. They want you to be head to toe. They want to see themselves as sports and athletic gear and not just sneakers. As you see in 2014, they hit the model. The industry, when you look at all the companies in the industry, including Skechers and Nike, the industry is at 12.2 times. That's perfect because that's every 30 days. Okay, so the industry is clearly okay with that standard. Skechers is below the standard, and Nike is even further below the standard. Again, most companies in the industry are waiting 30 days to get paid on their receivables. Nike's waiting 43. That's a problem. So if I were the head of Nike Finance, I would bring everybody in the room and show them this information. This is where we are. This is where we want to be. And my advice to them would simply be, just do it. Okay, eye roll. What do you expect? Thursday morning, these are the puns you get. All right, so let's take a look at how this works with the DoIt exercise here. We have LeBron James Company, of course. They had net credit sales of 923. Beginning receivables, ending receivables are listed here. So you can take an average of these two numbers here. Right? And then you compute what is the accounts receivable turnover for 2017. And then once you know that, you can put that under 365 and figure out the number of days. Okay. So what you see here is the accounts receivable turnovers in this first column. 923,000 is your net credit sales. You divide that by your average net accounts receivable. So you take the average of those two numbers and divide them. And here you get 24.9 times. That's way higher than 12. So clearly they're doing a fantastic job of collecting money. But what would you expect from LeBron James? Not mediocrity. You expect really good stuff. So here we go. Once you know it's 24.9 times, you can put that number underneath 365 to figure out the average collection period in days. And they're basically collecting their money every 2 weeks, which is just phenomenal, right? Most companies wait up to 30 days. Here they're collecting them in 2 weeks. So they're doing something right, clearly. Okay, that is our analysis for today as well. Questions?